This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In this lecture, we're going to talk about audit risk, which is very, very important within the exam syllabus. In the last lecture, we were talking about risk of material misstatement. Is that the same as audit risk? Well, almost. We'll see in just a moment. But fundamentally, it's all about the fact that we must try and make sure that the financial statements are not materially misstated. Initially, of course, a reminder that we can never give absolute assurance about this, and that's because the accounts include estimates like depreciation, doubtful receivables, provisions for reorganisation. They all need a lot of judgment. Ultimately, we're not really like the police, like Interpol or the fraud squad. So our aim is not really to try and look for fraud. Otherwise, the audit would not be cost effective. And of course, the client wants the audit completed within a reasonable period of time. I could check everything, but that would probably take another year. So we never give absolute assurance. As you know, the phrase that we give, isn't it? Instead, we give reasonable assurance. Reasonable is such an important word in audit terms. In the exam, you will be asked specifically within a scenario to identify audit risks and explain how we should respond to that risk. So that's what the exam question will go for. I think it's fair to say they will always ask this as part of the exam at some stage. It's a key thing that we can look at a business, see what might be wrong, and start to suggest how we should respond and sort out the problem to see if it is actually wrong or not. So risk and response, a very important phrase in terms of the exam. In the last lecture, we talked about the concept of risk of material misstatement, and we talked about the fact that this meant that the financial statements may be materially wrong or have a material omission. Audit risk is really just slightly bigger than that, because it's one thing to assess what the chance of an error is. It's another thing to assess whether we will spot that error. And so, in fact, if there is a chance that inventory might be misstated, we also have to assess whether or not we will spot that error. And this we call detection risk. So what's the chance that we'll miss the error? These are all sorts of things that have to be taken into account at the planning stage. You can see here, if you look at this page, actually 4 words: audit risk, inherent risk, control risk, detection risk. And really, audit risk is the chance that the accounts as a whole are wrong. So effectively, if I just on this diagram here label this as audit risk, what's the chance that the accounts are wrong and we miss the problem? Well, you have to start out by saying, well, what's the chance of an error in the first place? That's inherent risk. What's the chance the client will miss it? That's control risk. And what's the chance that we miss it as well? That's detection risk. And the audit partners in the audit firm have to make a decision, and perhaps they say, well, we have to live with a certain level of risk because we cannot give absolute assurance. So they'd never say what that level is, but perhaps if I just said 2%, in which case we have to think, what's the chance that inventory will be wrong? What's the chance that the client will pick it up? What's the chance that I'll pick it up? And if it's wrong and the client misses it and I miss it as well, of course, that means I may end up giving the incorrect opinion. So again, you can see back up here, audit risk is the risk of an inappropriate opinion. So we've talked round it in very general terms. We'll see more formal definitions later in the notes. What's the chance of an inappropriate opinion? Well, it depends. What's the chance of an error? Inherent. What's the chance controls miss it? Control. What's the chance I miss it? These first two here are known as the term we were using in the last chapter. These two are risk of material misstatement. Lots of jargon, isn't there? But we'll get used to it as we work through this chapter and through the rest of the materials. That's the problem. Will we give the wrong opinion? Depends on the chance of an error, the client missing it, and us missing it as well. Now, you can express that mathematically, but I don't want you to worry about the maths, because as it says here, audit risk is the product of inherent and control risk and detection risk. So it may be that the audit firm's audit software will work things out in a mathematical way. We're certainly not doing that in the syllabus or in the exam. We're simply understanding how it is that we may end up in a position where we get the opinion wrong and therefore end up effectively in court. As we say here, don't worry about the maths of this. I think if you start to put percentages on it, we just end up with confusion. So inherent risk, the risk of the error in the first place. Control risk not detected by the controls. Detection risk not detected by us. In our notes, we've got some more formal definitions, which are just down here. So these are the definitions, again, that might help you in terms of the exam. So the first one, the risk of a misstatement that could be material. The second one, the control risk, the risk the misstatement will not be prevented or detected by the controls within the business. Inventory, one person counts the inventory incorrectly. There's a control that someone else counts it. What's the chance they'll count it wrong as well? And finally, of course, detection risk is our failure again to detect the error as well. So they're the elements of that model. Detection risk is sometimes subdivided into sampling and non-sampling risk. Auditors use samples because they can't test 100% if they're having to do audit procedures manually. Sometimes these days they're able to use technology known as audit data analytics where they can test 100%, but usually, traditionally, they've been using sampling. And with sampling, there's a risk that you may end up with an unrepresentative sample. If you did any statistics at school or anything like that, you might remember that. They talk about things like normal distributions, not in the syllabus, don't panic. Non-sampling risk is where you actually have an unrepresentative auditor, someone who's actually inexperienced on the audit team and doesn't really appreciate what they're doing. And you might say, well, that must never happen. It must never happen, but it happens, doesn't it? So when you buy 100 sandwiches from the same shop 100 days of the year, for 99 days of the year it's delicious. On the other day, perhaps a little flying thing has got its way into your cheese sandwich. So non-sampling risk at the end of the day is where you've got poor auditing. Perhaps you've got inexperienced, again, audit team member. It shouldn't happen. It might happen, so they have to take it into account. It's no saying, you can't say that everything will always work perfectly. There we are with the risk model. Now, don't get heavily into the maths of this. I think you can end up with you can end up with absolute confusion about this So keep it nice and simple. But I think the message is, if you look at these words I'm highlighting now, and that's to say, if inherent risk and control risk are high, that means the client is a disaster. You've got to make sure detection risk is low. And that means you've got to do more audit work. It's like a seesaw. So if on one hand, the client is going to get things wrong, I'm going to have to make sure that I don't miss the errors they've made. I'll do more work. And the other way round, of course, if you've determined that the chance of an error in the accounts is low, I can do less work. So I can cope with higher detection risk. Think about the seesaw again, one down, one up. High detection risk means that you're doing, again, less audit work. I think in the exam, if you're trying to type that, you probably just need to rote learn it. Because I think if you start to think about it, you get confused, don't you? So inherent and control high, detection low, more work, and vice versa. I would just learn it. That's the easiest way. Ultimately, having decided where those risks lie, again, then I would decide on response. And of course, the response, effectively, again, the response, we're going to talk about in a bit more detail. But if I've got to do lots and lots of work, perhaps I've got to get more and more evidence. Perhaps I've got to do procedures quite early on. Perhaps I've got to test more items. In the exam, it's possible that you're asked about the components of the audit risk model. They may ask you to explain what inherent control detection risk actually means. So I would make sure that you're able to come up with little definitions of each of them. In practical questions, they don't seem to go on about the audit risk model very much. I think as long as you appreciate the components and have the definitions, it's going to be fine. Now, if we come back to this concept of risk of material misstatement, something that we introduced in the last lecture is that the chance of errors in the accounts can exist at two levels. The whole set of accounts might be wrong, or individual balances and transactions might be wrong. This is very important now in practical questions, where they give you a scenario. Perhaps in the scenario, it's a retail business. Their sales are not going very well. The bank is putting pressure on them. Perhaps management are driven by profit-related pay. They're selling stuff that's high technology. So all sorts of information would be given again about that particular business. And now we have to assess what would be wrong in the accounts. When we talk about risk at the financial statement level, we mean the whole set of accounts is potentially wrong. So examples of this, again, you can see them quite well summarized here. So it could be, just picking up these words, fraud. So in other words, if management have profit-related pay, there's an incentive for them to overstate profit. And they can overstate profit in many different ways by putting next year's revenue in this year's profit and loss, by not charging depreciation, by not having a large enough allowance for doubtful debts. There are many things. So if there's some incentive like profit-related pay, you have to look at all sorts of aspects of the accounts, not just one of them. It could be they've got deficient controls, and in particular, again, perhaps they've got a new bad system installed by the director's brother-in-law, who's completely incompetent, that keeps for any transaction, posts 2 debits and 7 credits, in which case the whole set of accounts is in disarray. Or it could be that they've got doubts about going concern. And again, it could be, for example, that they've got a breach of bank covenant. I wanted to introduce that term at this stage. It's a very important term in business and in the accounts. When a company borrows money from the bank, they make promises. The promises include covenants of promises, and often they're linked to ratios. So they have to promise, for example, their current ratio will not go below 2. If it goes below 2, it's breach of covenant. The business may not be a going concern. So when you have those things, they could affect the whole set of accounts. Everything is wrong. How do I respond? Well, we can't be very specific about what you do. So we just need ideas for the exam. Make sure we're using experienced audit staff. Make sure we're perhaps less predictable. So in the past, we've always been to one branch, we go to other branches, and we turn up a bit unexpected. Make sure we've got more supervision over the audit work. So our response, again, is expressed in a bit more in generic terms. Effectively, again, more experienced staff, less predictable procedures, more supervision at the audit end to make sure that those are all covered. So those are things that could affect the accounts as a whole. So I'm just saying these are things that affect the financial statements as a whole. Everything is potentially wrong. In addition, of course, so in the retail business, it could be that the bank pressure, it could be the profit-related pay. In addition, when we talk about risk at the assertion level, we're talking about individual problems with individual balances and individual transactions. It's very important you can distinguish those words. Balances appear in the statement of financial position, otherwise known as the balance sheet. Transactions appear in profit and loss. Now, it could be in retail that you're worried about revenue and you're worried about inventory. You would then say, well, what am I worried about with revenue and inventory? Well, assertions are set words. Again, you'll see them set down here. It's these sorts of words. Accuracy, again, completeness, occurrence, existence. We're going to meet them properly in a later lecture. So at the moment, I'm not going to write out a great big list of them, but I'm just saying with balance sheet things, you're worried if I took something like inventory about completeness. Are they all recorded? Rights and obligations, do they belong to the business or do they belong to a customer? Existence, again, do they actually exist? Everything that's in the records. Valuation, is it in at the lower of cost and NRV? So we'll see those in a later lecture. But perhaps in retail, I'm worried in the balance sheet about existence of inventory. I'm worried about the value of inventory. In the profit and loss, I'm worried about revenue. So I'm worried whether the revenue is genuine. That's a word which is occurrence. Another one you'll meet later is cut-off. Is it in the correct period? So we'll meet these assertions in a later lecture and a later chapter in the notes. But I am concerned, again, about individual items in the financial statements. And again, what I would then have to do is to develop a response. And therefore, I'd have to design procedures to respond to those risks. So if it's receivables, I'm going to have to do much more work on receivable debt collection. And we'll see in later chapter that's things like monitoring the cash received after date, doing ratios like receivable days. With inventory, it's things like attending the count, making sure at the count we do test counts, comparing again the cost of the inventory in the records with the selling price of the inventory by looking at the sales order book. Now, a lot of those responses, again, we're only going to meet, as you go later into the syllabus, because as you get later in the syllabus and you understand how to audit each balance and transaction again, you get a better feeling about what to write for responses. So what have we said up to now? Let's just recap for a moment. We've said that we cannot give 100% assurance, it's only reasonable. The exam will ask us for risk and response. This chapter is principally thinking about risk, but introducing this idea of response as well. We spoke briefly about this theoretical audit risk model. As we said before, don't get mathematical. In the exam, the main thing is you appreciate that what we're auditing is the fact the accounts are wrong, not the business is wrong. No one's interested in that. We want to know if that balance sheet and that profit and loss are fairly stated. So what's the chance there's been error? What's the chance it's not being picked up by the client's internal controls? Those errors at two levels. The accounts as a whole could be wrong, and in any scenario there might be one or two of those. And individual balances and transactions might be wrong as well. Again, in any scenario, then we'd have to think about those as well. They're not going to ask you about something difficult like a bank, but if I just said to you, bank, what do you think the key balances are at a bank? I guess it's their receivables and their payables, isn't it? So they would be the things that the audit of the bank would be concerned about. So you won't get a difficult business. You'll get something regular like a retail or a manufacturing business. So don't stress about that. But as you walk around, as you go shopping, just say, imagine I was auditing this supermarket. Which balances, which transactions might be wrong? I'm afraid to say that's what I do on a daily basis. Finally, the ISA that deals with this, you don't need to quote ISA numbers, of course, in the exam, has recently introduced some new definitions. I think you should just be aware of these. They're not really changing things significantly, but in the new ISA, they've talked about the spectrum of inherent risk. A bit like when you did physics at school, I think it was physics, where you would plug things in and see if there was any current. I never understood physics, and you'd see a little meter, wouldn't you, whiz up and down. That's about the spectrum. What's the chance of inherent risk? What's the chance of it occurring? What's the chance of it being major? And when we look at the spectrum of inherent risk, how serious is the problem? What's the likelihood, again, of the particular problem occurring? What's the size of that problem? So what is the materiality? What's the significance? I'll say again, what's the materiality of the problem that arises? It's those sorts of things on the spectrum. What the auditor must, of course, do is drill down to significant risk. And one of the reasons why audit partners are remunerated or paid so well is they can look at a set of draft accounts and they can say, right, audit team, there are 3 things in these accounts that potentially might be wrong. Go out and focus your effort on these because these are the significant risks. I think you should learn that definition for this exam. It's the chance of something which is close to the upper end of the spectrum. So again, it's something that's significant and very large, a major chance of occurring, which of course we would then need to focus on in designing our procedures. Final point that's added right at the bottom though is to say, well, it doesn't mean that you ignore all of the balances. You will still need to test the numbers, don't you, for anything that's material within the accounts. Share capital often doesn't change, so they don't need to do much work, but they still need to do some. It will be very embarrassing if you found out later that half the shares had been redeemed. So that's it in terms of our introduction to audit risk.